The Dow was down 900 points. Oil was up to almost $120 a barrel, and investors were beginning to panic. And then the President of the United States got on the phone and said 5 words that flipped the entire market. So here's where we are. The war in Iran is now in its 10th day. The Strait of Hormuz, the choke point that handles about 20% of the world's daily oil supply, has been effectively shut down. Iraq's 3 biggest oil fields saw output collapse by 70% because there's literally nowhere safe to store the crude oil. Kuwait started cutting production preemptively, and all of that pushed oil to $119 a barrel by Sunday night, the highest level since the war in Ukraine started in 2022. Markets opened ugly. The Dow cratered nearly 900 points, and the S&P and Nasdaq didn't fare much better. Investors were gearing up for another sell-off like we saw last week, and then 2 things happened. First, the Financial Times reported that the G7 finance ministers were jumping on an emergency call to discuss tapping the strategic petroleum reserves. Finally, some relief. See, these reserves contain around 300 to 400 million barrels of crude oil and other refined products, roughly a quarter of the entire global emergency stockpile. That alone knocked oil prices back to $105 a barrel. And then, Trump told CBS reporter, and I'm paraphrasing here, that the war is very complete, mentioning that Iran has no navy, no air force, and no communications left. And trust me, the markets heard that. The Nasdaq 100 closed the day up 1.34%, small caps climbed 1.09%, and the S&P 500 finished the day up 0.88%. A massive intraday swing. Now, is the war actually over? No. Iran just named their new supreme leader, succeeding his father who was killed in the initial strikes, and Trump has already called the pick unacceptable. Israel has threatened to target anyone put into the role, so the geopolitical risk is very much still alive. But for today at least, the markets decided that they'd take Trump at his word. And the G7 signaling it would flood the market with reserve oil was enough to take the panic off the table. Alright, shifting gears to AI, Nvidia is reportedly getting ready to launch an open source AI agent called NemoClaw. This is basically Nvidia's play into the Claw space, which are open source AI tools that run locally on your machines and complete tasks autonomously. Think of them as little digital employees. Nvidia has been pitching this to Salesforce, Cisco, Google, Adobe, and honestly anybody who will listen ahead of the GTC Developer Conference set to take place next week. The interesting part? Companies can use the platform even if they don't run on Nvidia chips. That's a departure from their usual CUDA playbook, where everything is locked into Nvidia's hardware. This could be Nvidia saying one of 2 things. Either they recognize that AMD is producing adequate AI chips and are adapting to that rather than fighting it, or they're assuming that once you fully adapt to use their AI agents, you'll kind of have to upgrade to their chips just to run them successfully. Now over to one of the biggest individual stock moves of the day. Hims is absolutely ripping, up about 40%. Novo Nordisk and Hims settled their patent infringement lawsuit and announced a partnership where Hims will sell FDA-approved Wegovy and Ozempic, including the new Wegovy pill, directed through its telehealth platform. In exchange, Hims has to drop all of its compounded GLP-1 products. This is a huge deal for both sides. See, Novo is getting a massive digital distribution channel for its branded drugs, and Hims gets a legitimate long-term supply of the most in-demand medication on the planet. These 2 companies had tried this once before, but Novo killed the deal after Hims kept selling its copycat versions as well. This time, it looks like both sides are actually committed. Now, if you remember back to a couple weeks ago, we were discussing the Anthropic Pentagon drama. Well, today that got escalated with Anthropic officially suing the Pentagon. 2 federal lawsuits, one in California and one in DC, are challenging the Trump administration's decision to label the company a supply chain risk, a designation that historically has been reserved for foreign adversaries and not American startups. The backstory? Anthropic refused to let the military use its Claude AI model for autonomous weapons or mass surveillance of US citizens. The Pentagon wanted unrestricted access for all lawful purposes. When Anthropic wouldn't budge, Trump posted on Truth Social ordering all federal agencies to drop Anthropic immediately, and Defense Secretary Pete Hegseth formalized the blacklist. Anthropic says it could lose hundreds and millions in revenue just because of the blacklist. Dozens of researchers from OpenAI and Google DeepMind actually filed a brief in their personal capacities supporting Anthropic's position. Only time will tell how this story wraps up, as the Trump administration has not been known to budge and Anthropic refuses to roll over. Two quick things before we go. Shell is selling Jiffy Lube, yes, the oil change provider, to a private equity firm named Monomoy Capital for $1.3 billion. That's more than 2,000 locations and over 19 million customers a year. Now, Shell's had Jiffy Lube for over 20 years, but the CEO is letting everything that isn't a quote-unquote core asset go, and is collecting a pretty penny while he does it. Investors were surprised that they decided to get rid of the Quick Lube franchise, as it is quite a customer base here in North America. And in private credit, which if you haven't been following is having a rough stretch, Blackstone's flagship $82 billion credit fund, BCRED, saw record redemption requests of 7.9% last quarter, about $3.8 billion worth. That's above their normal 5% cap, so the firm and its employees had to put in $400 million of their own money to cover the gap. This comes right after Blue Owl Capital permanently halted quarterly withdrawals for one of its retail credit funds entirely. The concern isn't even based on the performance of the fund. BCRED has returned nearly 10% a year since inception. It's just that retail investors are getting spooked by the high-profile blowups in the sector and pulling their cash from funds that hold illiquid assets. Regardless, when the biggest names in the space are scrambling to meet redemptions, you kinda have to worry.